Hi there, my name is David Andolfatto. I'm with the Federal Reserve Bank of St. Louis. I'm here at the 40th Annual Fall Policy Conference, speaking with Erik Hurst of the University of Chicago. Erik's going to be presenting a paper called The Aggregate Implications of Regional Business Cycles. And thank you, Erik, for taking the time to come and tell us a little bit about your paper. So what is this aggregate implications of regional business cycles? Can you tell me what your paper's about?
Yeah, there's a large literature among many applied economists to try to use regional variation to try to learn about what was driving the aggregate business cycle during the Great Recession. So people go and say, hey, maybe we have variation. Something happened in Las Vegas. It didn't happen in Dallas. And maybe we could use the variation between Las Vegas and Dallas to kind of tease about mechanisms that were driving the Great Recession. So we come along and say, there is things to learn about the difference between Las Vegas and Dallas, but it's much harder to draw aggregate implications. What drove the business cycle from just looking at local variation in GDP and such from these local cities.
So can you give me an example of how perhaps other researchers have made a mistake in misinterpreting regional variation and ascribing incorrectly kind of a cause of the recent recession?
Yeah. So there's a large literature about the role of housing and how it affects households, me and you, in terms of our decisions. House prices plummet and we feel poorer, so we stop spending. And then, in that kind of story, you might hear this kind of phrase that demand-driven recessions, because the household sector felt poorer, and then all of a sudden it just didn't want to spend as much. So those types of stories people have done by running regressions, just simple statistical correlations between what happened to your house price and what happened to things like local employment in a given area. And they found places where house prices fell the most, Las Vegas, they had the biggest decline in employment relative to places like Dallas. Now, the problem with those stories is when you look at what's going on between Las Vegas and Dallas, policymakers like the Federal Reserve could come along and offset those types of shocks by lowering interest rates, trying to stimulate spending on the household side. Exactly what the Fed did in 2008, 2009, 2010, and such. And if that's the case, any shock like that at the aggregate level could be offset by the Federal Reserve. And because the interest rate's the same in Dallas as it is in Las Vegas, then all of that gets differenced out in your little correlations between
What does that mean, differenced out?
Differenced out, it means affects both of them.
Okay.
So low interest rates were in Dallas, low interest rates were in Las Vegas.
Okay.
That increased spending in both of those places. So if the housing shock declined spending, the interest rate shock could have increased spending, and that could push against each other, but you wouldn't be able to tease that out by, think about it this way. You have a line between, just a graph in your head, a simple graph with how much your house price has declined on the one axis, and each observation, at least a little dot in this graph is a city, and how much employment fell, okay? And what the regional variation gives us is like the slope of that line.
Okay.
What it doesn't give us is the intercept of the line, where the line's going to, how high or how low the line is.
I see.
And anything that moves all cities up and down you'd have no way to identify this. So we're kind of talking about, thinking now hard about this variation between Las Vegas and Dallas and how you need some structure to do this. You need a little bit more kind of modeling and kind of assumptions, exactly. Then how does that all aggregate up? So then we could talk about policy that affects at the aggregate level as well.
Okay, so let's see if I understand it, and I'm not sure that I do. And when you say things like the housing shock, now if my understanding is there's a great deal of regional heterogeneity in the housing shock. I mean, Las Vegas home prices fell a lot.
Yes.
It's probably not surprising that the construction sector was hit and construction workers got laid off. That seems kind of obvious. And other jurisdictions were not so hit hard. I mean, to a lot of people, this just seems like common sense. So, but it's still not clear to me, based on kind of this common sense kind of observation, how does an economist potentially go wrong in identifying what ails the economy and what should be done.
So
it's still not entirely clear.
Yeah, no, let me kind of then put a little bit more structure on this, okay? So here's a fact. I'll give you a fact, and then we'll kind of show you how that fact differs at the aggregate level, the U.S. as a whole, and how it differs between Las Vegas and Dallas, these little locations within the U.S. So the fact is, during the Great Recession, wages, okay, nominal wages and then price-adjusted wages, I'll talk about both, but nominal wages in the U.S. actually rose from 2007 to 2009, 2010, 2011, despite very weak labor markets. And real wages stayed right on trend. Real wages have been essentially growing at zero rate since, at least 2000, probably before. And during the recession, real wages grew at 0% from 2007, 2008, 2009, 2010. So you look at the data and you say wages aren't adjusting that much during this recession, despite the fact that we had a huge decline in the employment. And you might think in your head, if firms don't want to hire as many workers, the price of workers should fall. Okay? So people have told stories now that there's some friction. Okay, that's just something messing up how the economy works, and how the wage setting process is part of the thing that makes the recession worse. So a shock comes along, something that caused a recession. In a world where wages don't fall, certain types of shocks could have a bigger effect on employment.
Sure.
Okay? And so certain types of shocks, like a housing shock, could have bigger effects at the aggregate level if wages don't adjust. So that's one thing. Now then you go look at the local data. And again, this might not be surprising to a lot of people. But when you go to the local data and you look at Las Vegas and the employment is falling, and you see wages are falling like crazy. So it doesn't make sense. Anybody who's working in Las Vegas now probably knows that their wages were growing at a lower rate than it would have been in the pre-recession periods. Okay? And when you compare them to Dallas, whose wages were growing relatively robustly during this period, you could see there's a variation. Now this becomes a puzzle, and this is the whole part of the paper. So the first part of the paper is just setting up this puzzle, and I think that's kind of value added and above in itself. No one's ever, it sounds crazy when you're listening to this, for the first time, that no one has ever looked at local variation in wages at during big recessions to get a sense of how wages adjust. We do that, okay? And so we put together data to try to measure wages, adjusting for the fact that, certain types of people might lose their jobs and we might not be able to observe their wages. So you have to make some adjustments for that. And then you look at the data and it looks like places, again, remember this kind of picture in your mind. Now you have, how much employment has changed in each city on one axis and how much wages have changed on the other axis. And you see places with the biggest unemployment increases or the biggest employment declines had the lowest wage increases. So that variation across regions doesn't look like the variation at the aggregate. At the aggregate, big increases in unemployment, no change in wages. At the local level, big increases in unemployment, big relative declines in wages. So that's the puzzle.
I see.
So and this is why the title of the paper is The Aggregate Implication of Regional Business Cycles. Yeah. If the variation, at the local level is different than the aggregate level, what does that mean when the U.S. economy is just the sum of the local levels?
Right.
And so that's the puzzle that we're setting up with in the paper.
So really, that's an interesting observation, and I haven't heard people make that observation. So now that's the puzzle. You've identified the puzzle. You develop a theory to kind of interpret the puzzle or understand it. What's your theory about what's driving this puzzle?
Okay, so now we try to do like I just said. So we're going to take each one of these parts of the U.S., okay? You could think cities or states. In our data, it's actually going to be U.S. states. So we're going to, instead of Las Vegas versus Dallas, it's Nevada versus Texas. And we're going to make a model of each one of the U.S. states that aggregates up to the U.S. as a whole. So anything that goes on in these local areas eventually has to sum up to what goes up at the aggregate level. And in our model, there are certain types of shocks, okay, and then certain types of assumptions on what the households do, what the firms do, what the government does and stuff. So let me tell you about these shocks, the things that could drive business cycles in general. And these are kind of metaphors for the types of shocks that most of us have talked about during the recession. So we have some shock that hits the household sector, okay, that makes them want to spend less. Okay. And you could think about that as being like a housing shock. Okay, people have told those stories that house prices have fallen, people can't borrow as much money to fund their consumption. So we have one type of shock that looks like that. We have another shock that hits kind of the firms. And those firms make those shock makes firms want to hire less at any given wage. So maybe like a productivity shock on the part of firms, or maybe a borrowing cost shock for firms. Firms might go to banks and maybe not be able to borrow as much. And
just to clarify, then these shocks you're modeling as hitting different regions individually, or as the economy as a whole?
Let me tell you the third shock, and then I'll answer that question. The third shock is then just a taste for leisure shock. Some people have said the story that something has made us want to work less than we did in the past. Maybe it's our government policy has made us want to work less. Maybe something hits certain sectors like manufacturing, and it takes a while for workers to reallocate to other sectors. Okay. So those are the three types of shock. Okay. Every one of these shocks has an aggregate component and a regional component. Okay. And we define the regional components so that they sum to zero. So anything that moves all regions, we're going to call an aggregate shock. Okay. And anything that moves your region relative to the aggregate, we're going to call a local shock. So every shock has those three components.
And this is something you're going to estimate using the data and using the model.
Exactly. Okay. And then you could try to, do, let me just tell you two other things about the model. Sure. I think that it'll be important. The first thing is that, regions are connected to each other. So they could trade goods with each other. And as a result, shocks that hit you might spill over into me, because if I produce cars and you're in Las Vegas and you don't want to buy as much, it's going to affect how much I'm going to produce there. So we could trade with each other, and so that's one thing that makes the regions different than the aggregate. The second thing is there's a Fed, okay? And the Fed is in the background, and they're moving around interest rates, and the interest rates are the same in all the places of the U.S. So the interest rates is the only shock that has no regional component. Okay, so we're going to have a fourth shock I should have mentioned, which is the interest rate shock.
I don't like you modeling the Fed as a shock.
Yeah, there is I should be very precise, there's a Taylor rule.
Okay.
And then sometimes they could do things to move us above and beyond a Taylor rule. So that's good. I should be very clear about that. And then the last thing is the assumption I'm going to have, and this is what we're really going to estimate, is how sticky nominal wages are. Okay. So that's the key friction in our
and this economy. Is a local stickiness.
Yep, it's a local stickiness. There's a local stickiness to local shocks and an aggregate stickiness to aggregate shocks. Because eventually, everything's going to aggregate. And the way that we've aggregated, I should be clear, is the local wage stickiness parameter, which I assume is the constant across all regions, will then, because they aggregate, will then map directly into the aggregate wage stickiness.
Let me be clear, though, and you introduced this local nominal wage stickiness because it's going to be necessary for your model to interpret the data?
So it'll be necessary to do, so it has twofold. Yeah. One is those spending shocks on the household sector don't really have any effects on recessions unless you have some friction in the model. Okay. So we needed some friction. Yeah. And the second thing is, when you look at the data, it screams there is some wage stickiness. Okay. Shocks that change affect today might not affect your wages until tomorrow. Why? Because our wage contracts, me at the University of Chicago, my wages are set once a year. So things that happen in December don't show up in my wage setting until the
So it's consistent with what we observe at the local level as well.
Exactly.
Very good. So you develop this theoretical framework. You've got your interpretation. Now, I guess you go out and formally estimate using econometric techniques how well the theory. You choose parameters so that the theory has a best fit for the data that you have. And so what are your findings? What is the interpretation that your model offers, and how does it differ from the conventional interpretation?
Okay. So let me tell you, a key input into our model when we do this, because a lot of the parameters, again, that are going to be used are kind of standard in literature. What wage stickiness is not standard. So a lot of our paper is on trying to estimate how sticky wages are. And as I told you before, when you look at the regional data, you're going to find some stickiness in wages, but it's not huge. Okay. So then you go, and so just trying to think about what the identification is going to come from, after this, is when you go to the aggregate data, and then certain shocks, particularly the household spending shock that we talked about, this demand shock that is hitting the economy, potentially because you and me, the household sector, don't want to borrow or can't borrow as much as we did before. That shock should cause wages in the aggregate level to fall. Now, some people have come along and said, well, the only way that you could, if you believe this shock was the cause of the recession, it was all me and you in the household sector, you should see wages fall. They say, well, wages must be really sticky. And then, the part of our paper comes along and says, well, if they're so sticky, then we shouldn't see wages moving at the local level. And reverse it, given the flexibility we see at the local level, it is hard to get this household shock to do a lot of the work for the recession. So people who believe that the recession was, again, this is a phrase that's kind of loose, but demand-driven, driven by the household sector wanting to stop spending, and that's the sole story for the recession, we reject convincingly. Because if so, wages should have plummeted.
Okay.
So what we find is that about 40% of the decline in employment in the early part of the recession, 2009-ish, could be attributed to a demand shock above and beyond what the Fed was trying to fight against. So the Fed is always trying to push against this demand shock. As the recession gets to 2010, 2011, the reason why employment was still low in 2010, 2011, 2012 had very little to do with the demand shock. Because if it was all demand shock, wages would have adjusted to clear the market. So something was happening to the firms in the economy is what we estimated. For whatever reason, firms didn't want to hire. Maybe their productivity was low. Okay? Maybe they had some, friction in their lending, in the banking sector, at the aggregate economy as a whole. I can't distinguish between those. We don't even try to distinguish between those. Those are kind of lumped together. The whole point was it wasn't the household side that was causing a drag on the economy in 2011, 12, 10. We stop at 2012. So anything about the recovery in recent years is outside the purview of the paper.
And is this conclusion or this finding of your paper in contrast to, let's say, Meehan and Sufi?
Yeah, there's work by Meehan and Sufi. Again, Meehan and Sufi are kind of nuanced interpretations we should be doing. They were really talking about 2009, and they were trying to explain a lot of the early part of the recession in 2009 was driven by the household sector. And some inside the Fed used the work of Meehan and Sufi to bolster a demand-driven type of recession for which the Fed should be working against. We're saying that was part of the story, so they weren't wrong. But once you go through 2010, 2011, 2012, you can't have their story being the story, because if so, wages would have fallen unless wages were really, really sticky. And we just estimate from the local level wages aren't really, really sticky. So it reinterprets the way. So in the, from the Fed's perspective in 2010, 2011, 2012, maybe they're propping up the banking sector, but maybe it's to help the firms in the economy more than to help the households in the economy.
I see. So, so that your findings don't necessarily preclude kind of a balance sheet recession, but the findings are that whatever these forces were, it moved from the household sector to the business sector.
Perfect. That's a perfect
summary. So, in terms of say policy implications, does the theory, I mean, you step back and you take a look, your model kind of fits the data kind of nicely at the local level as well, which I like a lot. It offers this intriguing interpretation of the crisis and subsequent developments. Does the model, scream for any kind of obvious policy intervention or?
So there's two things that I think policymakers should take away, and I still hear some of it in the rhetoric even within the Federal Reserve right now about the stickiness of wages. So you hear the reverse size now. So the story you'll hear within this Fed right now is because wages didn't fall in 2010, 2011, 2012 because they were so sticky. Part of the reason we're not seeing a wage increase in 2013, 2014, 2015 is because we're just undoing pent-up demand. And that's just not, I just don't believe that is a true assessment to have. I'll even go further. You know, this is off topic just slightly for a second, is that when you look at real wage growth from 2000 to 2007, well before the recession started, it was zero. Okay? When you look in wage growth now, it's zero. So real
Zero.
wage growth. Real
From
wage
2000 to 2007?
Real wage growth. Real wage growth. Wage divided by the CPI. Now, maybe you think the CPI is mismeasured. There's people who tell us, but again, wages relative to the CPI, essentially zero from that period. And we're right back on trend. Now, during the recession, you know, if wages were really sticky, maybe that's why they didn't fall. But we're saying wages are pretty flexible. So what was going on is there's something else pushing up wages. And I'll tell you, and we didn't talk about this yet, the thing in our model that's helped pushing up wages that we are estimating having some effect on aggregate employment, but a lot on wages, is that there seems to be something causing the household sector not to spend less, but to choose is a strong word, to work less. And whether that is a choice or whether certain sectors have gotten hit, and then as a result, people have trouble reallocating to other sectors, the data says that is pushing upward pressure on prices. So for us in the Fed or policymakers, I think what we're finding is also evidence of the same puzzle of why employment has not bounced back even as of 2015. Unemployment rate has come down, but the employment rate plummeted from 2007 to 2009 and has stayed low for workers who usually work. People 21 to 55.
Right.
And I think that same puzzle is explaining why wages at the aggregate level didn't fall, and or the same shock explained why wages at the aggregate level didn't fall, and why employment is still depressed in the U.S.
So largely this sounds like an identification of the types of disturbances, the nature that they have to take to interpret the data. But in terms of like a direct policy implication, say the fiscal authority, I mean wage subsidies. I mean, your model doesn't.
I'm going to go off a little bit more.
Yeah.
The traditional policies that I think that story could that could respond to that story aren't the usual ones we think of the Federal Reserve and Congress and presidents doing as short-run stimulus. These might be things like job training programs or retooling workers to move them from manufacturing towards IT or some other sectors, which isn't the usual types of policies we talk about inside.
Not the demand management policies, more of a long-term structural kind of
reallocative,
assist workers to reallocate to better jobs. So that's really great, Erik. So just to conclude, I was wondering if you could take a moment to just give us a few takeaway points from the research that you've undertaken here with your co-authors.
Perfect.
What are the takeaways?
I'll take three of them. Okay. First, for those of us who want to do empirical work, using cross-region variation to try to learn about the shocks hitting the economy, it is more complicated than we thought when you're trying to make aggregate, understand what's driving the aggregate business cycle. Second, and I think this might be the most important and most lasting of what we do, wages are pretty flexible at the local level. So when we start building models of aggregate wage stickiness, we have to be confronting the fact that when you look at the difference between Las Vegas and Dallas, unemployment rates and wage rates correlate, very strongly. So we need to keep that in mind when we're doing this. And wages, once you do that, wages look a lot more flexible at the local level than they do at the aggregate.
Thanks a lot, Erik.
Perfect.
So that's great. Thanks for taking the time to tell us about your paper. Enjoy the rest of the conference and enjoy St. Louis.
Perfect. I loved being here.
Excellent.